Most people make money feel more mysterious than it really is. They speak about wealth as if it were some kind of private religion practiced by a different species. They imagine there must be hidden handshakes, secret clubs, impossible luck, rare genius, or some magical appetite for risk that ordinary people simply do not possess. I do not believe that. I think wealth is difficult. I think it is emotionally demanding. I think it punishes confusion. I think it exposes character. But I do not think it is mysterious. When you boil the whole subject down far enough, there are only a few structural ways to become truly wealthy. Not comfortable, not respectable. Not upper middle class with a nice kitchen and a fragile dependence on the next year going smoothly. I mean wealthy enough that money begins changing the shape of your choices. Wealthy enough that your life is no longer held together only by labor. Wealthy enough that ownership starts doing a meaningful share of the work. That is a very different standard. And once you define the goal clearly, the paths narrow dramatically. There are really only three. You build the machine, you buy the machine, or you enter a machine that already exists, earn unusually well inside it, and convert that income into ownership before lifestyle inflation swallows the opportunity. That is it. People dislike this answer because it is too clean. They want more romance, they want a loophole. They want a fourth path built from charisma, cleverness, and the right app. There may be ways to look rich. There may be ways to sound rich. There may be ways to spend like a rich person for a while. There are not many durable ways to become rich. Those three cover almost all of it. And what makes them difficult is not that they are hard to understand. It is that each one demands a form of discipline most people resist for years before they finally accept it, if they accept it at all. The first path is to build the machine. This is the path that receives the most mythology because it produces the most dramatic stories. The founder, the operator, the builder, the person who begins with an idea, a problem, a gap, an inefficiency, a market nobody else has yet served properly, or some useful thing done better, faster, cheaper, or more reliably than before. That person does not become wealthy because he worked hard. A lot of people work hard. He becomes wealthy because he built something that could scale while he retained enough ownership for the scaling to matter. That is the whole formula, not effort. Ownership multiplied by scale. I want you to understand that because the public is often misled by the theater around entrepreneurship. The public sees the hustle, the late nights, the pitch decks, the social media posts, the identity, the storytelling. That is all surface. The real engine of founder wealth is much simpler. If you own a large enough piece of a value-producing system, and that system becomes much larger, your equity becomes worth a great deal more without moving linearly with your personal effort. That is what changes everything. Labor scales badly, ownership scales beautifully if the underlying machine is strong enough. Suppose you earn $300,000 a year in a job. That is excellent income. I will never mock excellent income, but the money still arrives in a line. You may double it through promotion, negotiation, or unusual skill. Fine, you are still dealing with a line, a better line perhaps, a more admirable line, still a line. If you own 60% of a company that goes from 1 million in revenue to 10 million, or 10 million to 100 million, the resulting wealth is not a simple extension of your daily labor. It is a repricing of ownership. That is why founders so often look overpaid to people who only understand salaries. They are not being paid for hours. They are being repriced for control of a scalable asset. That is a different universe. And this is where most people get confused. They think building wealth through entrepreneurship is about passion. I have never found passion to be a sufficient business model. Passion may help you endure the beginning. It does not create economic leverage by itself. The real work is structural. You identify a real demand. You produce a repeatable answer. You standardize delivery. You improve distribution. You protect margins. You keep enough equity. Then if the market is large enough and execution is competent enough, the machine expands. That is what you are really trying to build, not a job for yourself. A machine, if the business cannot detach from your daily labor, it may feed you very well, but it is less likely to make you truly wealthy. That is one of the cruel dividing lines in entrepreneurial life. A person may own a respectable business and still not be building real wealth if every dollar depends too directly on his continued presence. Many people start companies and end up owning expensive jobs. That is not failure, but it is not the same thing as owning a scalable machine. I have seen this many times. A person becomes very good at something, a trade, a service, a specialized process. He begins charging for it. Demand rises. He gets busier. The income grows. Everyone around him says he is successful, and he is in one sense. but the business still depends too fully on his own labor, judgment, energy, and time. If he stops, the machine slows dramatically. That is not the founder wealth equation. Founder wealth appears when systems, distribution, and retained ownership combine in a way that allows the value of the company to outrun the personal hours of the founder. That is what the public keeps missing. The point is not merely to create. The point is to create something that can detach from you enough to become bigger than your body. That is the first path. And it is brutal because the risk sits up front. Income is unstable. Identity is unstable. Feedback is often humiliating. Most new businesses fail. That should not be hidden from anybody. The upside is not normal. The failure rate is not normal either. This path attracts people who can survive volatility in self-image, volatility in cash flow, and long periods where the world gives them very little evidence that the thing will work. That is a real cost. And even then, many people still fail at the decisive moment. They scale the business but give away too much equity. They build demand but never build margins. They create something useful but never master distribution. Distribution matters far more than naive people think. A superior product with weak distribution dies all the time. A merely decent product with excellent distribution can dominate for years. People like to believe excellence wins cleanly. In business, excellence must still be delivered, repeated, seen, sold, financed, and protected. That is why I say founder wealth is not about building a thing. It is about building a machine. Now let me move to the second path because it is quieter and in some ways more civilized. You buy the machine. Not everybody should build. Not everybody wants the chaos, uncertainty, ego, risk, and brutal operational volatility that comes with being the creator. Fine. You do not need to create the engine to become wealthy. You may buy ownership in engines that already exist. This is what investing properly really is, not prediction ownership. That is one reason I have always preferred the language of ownership to the language of trading. Trading attracts impatience. Ownership attracts seriousness. When you buy a broad market index fund or a stake in a business or a rental property with real cash flow or productive farmland or some other asset whose value rests on underlying economic output rather than mere resale fantasy, you are buying a machine somebody else already built. That machine continues operating whether you are at dinner, asleep, in a bad mood, or on vacation. That is the whole attraction. Ownership decouples wealth from effort, not completely at first, not emotionally, but structurally. Yes, you do not need to show up at the factory for the factory to produce. You do not need to ring the register for the tenant to pay rent. You do not need to ship the software update yourself for the software company to collect subscriptions. That is the second path. And it is built on one principle above all others. Productive assets compound. This is another sentence people repeat without feeling its full force. If you own assets that produce earnings, cash flow, or durable appreciation grounded in actual economics, those assets can be reinvested, held, expanded, or simply allowed to grow over time. That time component matters so much that I think most people still underestimate it even after hearing about it for years. When you invest $20,000 a year into productive assets and earn a normal long-term return, the ending result is not the sum of your yearly deposits. That is the childish way to imagine the process. The real result comes from contributions plus the growth on contributions plus the growth on previous growth. That is where the curve bends. In the first years, the process feels modest. Later, it begins feeling almost unfair to people who did not start. I have lived long enough to watch this pattern become emotionally visible. The early years look unimpressive. Then something changes. The base becomes large enough. The annual return begins becoming meaningful in dollar terms. Suddenly, a decent year in the portfolio looks like a second worker joined the household. That is what the second path offers. Not speed first, scale later. Now, what counts as a productive asset? This is a question people answer badly because they keep confusing price movement with productivity. A productive asset does one of two things, and the best ones often do both. It sends cash to the owner or it becomes more valuable because the underlying earnings and usefulness of the thing are improving. Public equities qualify, broad index funds qualify, a profitable rental property can qualify. A private business stake can qualify, a sensible fund investing in productive enterprises can qualify, a barren speculation that depends only on a greater fool paying more later does not qualify simply because a chart went up for a while. That is one reason the public stays confused about wealth. It keeps treating motion as value. Motion is not value. A thing is not an asset because it had a good year. It is an asset because it sits on top of real economic production. That distinction should guide almost every serious investment decision. The second path is slower in the beginning than the founder path. It is often calmer too. You need less personal volatility, less identity risk, less direct operational chaos, but you still need the most important ingredient, surplus capital. And this is where a great many people get trapped. They like the second path in theory. They just never generate enough real investable surplus to make the compounding meaningful. That is not a market problem. That is a life structure problem. You cannot buy the machine in serious size if every dollar of income is already spoken for by the life you built to look successful. This is where the third path appears, and in many modern careers, the third path is the bridge between labor and ownership. You join the machine, then you convert income into ownership. This path is not as theatrical as building and not as immediately peaceful as simply investing existing capital. It is a bridge path, a specialist path. You enter a high-leverage system, get paid unusually well because you are positioned close to scale, and then you behave differently from most high earners. You do not merely consume the income, you convert it. That is the secret. Not the salary itself, the conversion. This is one of the biggest misunderstandings in money. The public thinks high income automatically leads to wealth. I have met far too many high earners to believe that nonsense. High income helps. High income can also finance a more expensive trap. A person can earn $400,000 a year and still remain structurally fragile if the whole amount is being consumed by taxes, liabilities, image, housing, lifestyle, and a family system built to match what the income can currently support instead of what it can someday own. That is not wealth. That is a better fed treadmill. The third path only works when the earner understands that the job is not the destination. The job is the extraction point. You enter a system where leverage is concentrated. Technology, finance, law, enterprise sales, capital-intensive sectors, executive positions close to decision, making and bonus pools. You become economically valuable inside that system. Then, instead of merely living better, you begin buying ownership with the excess. That is what separates the wealthy specialist from the well-paid employee. The wealthy specialist uses the job to fund assets. The well-paid employee uses the job to fund a larger life. Those two people can stand next to each other at a party and look equally successful for years. 10 or 15 years later, their lives are usually very different. I have always thought one of the saddest financial outcomes is the high-income person who never converts. He works in a powerful system. He earns unusually well. He is close enough to capital to smell it. And he still fails to become an owner in meaningful size because he mistakes spending capacity for wealth. That is a very expensive confusion. The third path itself has stages. First comes skill, not hobby skill, not social skill in the flattering sense. Economic skill, a skill that drives revenue, reduces major cost, allocates capital, manages serious risk, or sits close enough to large flows of money that the compensation pool itself is different from ordinary work. This is what young people so often miss. They ask what they like. I would rather they ask where leverage lives, because the same degree of competence produces very different incomes depending on the system it is embedded inside. A strong skill in a weak system caps life. A strong skill in a scaling system opens much larger possibilities. Then comes proximity. You must get close to the decision point, close to the deals, close to equity, close to bonuses tied to enterprise value, close to carried interest, close to stock grants, close to the places where the machine rewards more than time. Many people stall here because they remain operators only, valuable operators, perhaps hardworking, respected, even admired, but still not close enough to the ownership layer. That is why they earn well and do not escape. Then comes conversion. This is the hard part because this is where the culture attacks. The culture celebrates the income and then immediately invites the person to spend it in ways that prove the income was real. Bigger home, better district. 2 financed cars, private school too early, lifestyle services, visible upgrades, a life that gets more expensive in exact proportion to the income that could have funded assets. That is how the bridge collapses. The bridge path works only if income is converted aggressively enough into ownership that compounding eventually takes the lead. Not after life has stabilized, not after one more bonus, not when the children are older. Now, during the high-earning years, that is when the bridge must be built. I have always thought the most important sentence for a high earner is this one. Your salary is not your wealth opportunity. Your salary converted into assets is the real sentence. And once you understand it, your whole financial behavior changes. Bonuses stop looking like proof of status and start looking like capital. Equity grants stop looking like lucky extras and start looking like serious opportunities. Raises stop being permission to inflate the visible life and become chances to grow the ownership life. That is when the specialist stops being just a worker with a better title and starts becoming a future owner. Now, all three paths are hard. The first is psychologically brutal because you must build amid uncertainty and absorb large risk up front. The second is emotionally difficult because it requires patience, surplus capital, and a willingness to let time look boring before it looks beautiful. The third is seductive and therefore dangerous because it hands you just enough income to look rich before you have actually become rich. Each path has its own trap. The builder S trap is ownership leakage, poor distribution, weak margins, and building a job instead of a machine. The buyer S trap is undercapitalization, impatience, speculation, and constantly interrupting compounding. The bridge path S trap is lifestyle inflation. That one may be the most common of all. Lifestyle inflation is not simply spending more. It is spending in a way that hardens the fixed cost of your life until your income must keep arriving at roughly the same elevated level just to preserve normality. That is a dangerous place to stand. It means your high income is no longer a wealth opportunity. It is life support. The wealthy do not usually become wealthy by turning every pay increase into a new permanent obligation. They become wealthy by letting some or much of every income increase become ownership. That is a completely different habit. And once assets get big enough, a beautiful thing begins happening across all three paths. They start converging. The founder may have built the machine first, but eventually he often shifts from builder into buyer. He starts acquiring other machines. The investor who began by buying the machine may eventually gain enough capital to become more selective, more concentrated, more private, more owner. Like in how deals are approached, the high income specialist who converted aggressively eventually joins the second group because the portfolio itself becomes meaningful enough that labor is no longer the whole engine. That is why I say the three paths are distinct at the beginning and more similar later. All of them, if successful, end in ownership. That is the final state. Not consumption, not income ownership. That is what the public keeps trying not to understand because ownership requires patience, responsibility, and clarity about what actually matters. It is much easier to discuss income. Income flatters the ego faster. Ownership flatters the balance sheet later. Later is where wealth lives. Now I want to say something about timing because this is where people start worshiping genius when they should be studying systems. Timing matters. It does. If you build inside an expanding market, the world helps you. If you buy productive assets during periods of panic or mispricing, time helps you more. If you join a system just as that system is beginning a long expansion, the compensation pools can change your life. But timing is not the whole story. What matters more is whether you are positioned in a way that lets timing matter if it goes your way. A man may be smart enough to see an expanding market and still miss the whole thing because he does not retain ownership. A person may correctly identify a wonderful asset and still stay poor because he never accumulated enough surplus capital to buy enough of it. A high earner may enter the perfect industry at the perfect moment and still not get rich because he converted the advantage into lifestyle instead of assets. That is why I prefer structural language to genius language. The world celebrates the timing. The structure usually deserves more credit. Now, if you ask me which path is best, I would say the question is too broad. The best path is the one your temperament can survive that matters. People imitate wealth strategies they are not built for. A calm person with modest ego and strong patience may do exceptionally well buying productive assets and compounding for decades. A highly energetic operator with pain tolerance and unusual appetite for uncertainty may be better suited to build. A highly skilled specialist in a leverage-rich industry may do best on the bridge path. Temperament matters because wealth strategies are not merely economic. They are psychological. The wrong strategy for your temperament can destroy you, even if it looks perfect on paper. I have always preferred the path that allows a person to remain intelligent under stress. That is the one most likely to endure. And endurance matters more than people think, because if you keep going long enough, all three paths tend to reinforce each other. The builder can buy. The buyer can build through acquisition. The specialist can become a serious owner. That is how a life becomes financially strong, not all at once. By moving from labor dependence toward ownership dependence, that is the real migration, and it is why I have so little patience for the way ordinary money conversations are framed. People keep arguing about how to make more money. Fine, that matters. But it is not the central question. The central question is this: are you moving from labor toward ownership? If the answer is no, then you may still improve your standard of living, but you are unlikely to become truly wealthy in the deeper sense. If the answer is yes, then the machine may be slow at first, brutal in stretches, boring in parts, and unfair looking from the outside, but you are pointed in the right direction. That is what matters most, not glamour direction. So let me reduce the whole thing one last time. You can build the machine and keep enough equity for scale to transform your life. You can buy the machine and let compounding work on productive assets over long periods. Or you can join a machine, get paid unusually well inside it, and convert income into ownership before the system trains you to spend the opportunity away. Those are the real paths. Different speeds, different risks, different emotional costs. Same destination, ownership. That is where wealth lives. Everything else is mostly noise.